Hello, I'm Bernard Hickey from interest.co.nz and welcome here to a double shot interview. Today we've got Sandy Meyer. He's the Chief Executive of South Canterbury Finance. He was appointed at the end of December last year, and previously his claim to fame was to be the guy who ran DFC when it was put into statutory management. Sandy, can you tell us who put you into the job at South Canterbury Finance? Who asked you? What was the background there?
I was asked by the board, initially by the independent directors who came in a few months before I did.
Because there's some people who say you're really the government's man inside South Canterbury.
Well, I tell you, if I'm the government's man and they're going to pay me and give me an indemnity, they better let me know sooner rather than later, because it's kind of cold and lonely so far. There's been a lot of speculation about that, I guess, due to some of the things I've done in the past, but you know, there's still wondering who killed President Kennedy. So,
what happened when you got in there? What did you find when you looked under the hood?
You know, my immediate task in December, Bernard, was to get a grip on cash flow and capital. And we had to do an operation towards the end of December to get the capital ratios to where we wanted them. And we began to work pretty seriously on January on liquidity. And, you know, we had some urgent concerns in those areas. And to some extent, they're still with us. We turned pretty quickly to extending the guarantee because we had maturities that were building up. So that task was finished last week, and that was a big one for us. And now we get to look at some of the longer-term issues.
How tight did it get in those first few months with cash flow in terms of how much money you had left in the bank?
Uncomfortably tight. You know, we are below the kind of level that we want to be at, and that we want to be at to maintain the sort of double B rating that we've got. So, you know, we're currently sitting with tens of millions of dollars, and I'd like to be at hundreds of millions of dollars.
Now, since December you've come in, there's been some capital injections by the owner of South Canterbury. Can you talk about what's happened there, and also what your plans are over the next few months in terms of capital restructures? Well,
Alan is a pretty exceptional individual in terms of his history and his philanthropy and his business acumen. And when we turned to looking at the kind of medium-term capital needs, there were a number of different things that we could have done. We examined a lot of possibilities. And Alan stepped up and said, well, you know, I'd rather deal with it myself by injecting equity in the form of vending into the company some of the companies that he owns separately and taking shares back. And that had a couple of virtues. These are companies that have been around for a long time. They've got very predictable values and cash flows. We had to get an independent expert certified by the government to do this, and we knew that it would pass that kind of sniff test because it was quite bona fide. It was fast, and it was willing. Other types of equity arrangements would have inevitably involved third parties and a lot of dickering, and we could have still been around today doing this, and we didn't have that kind of luxury of time.
Now, just looking at the related party dealings, this has always been a question about South Canterbury. What are your plans in terms of unwinding some of those related parties? And in particular, I noticed there's a big stake in South Island Farm Holdings, or a big loan, 68 million or so, to South Island Farm Holdings, which is Alan Hubbard's dairy farming operations. Is that loan performing at the moment? And how do you unwind all that?
Well, you know, the plans in a simple word are, yeah, we plan to unwind them. Related party transactions are not all necessarily bad transactions. You've got to work through each one. Some of the related party transactions with Alan are as a result of Alan putting equity into the business. And it's probably not the clearest, cleanest way to do these transactions, but some of them are quite beneficial. How do you unwind them? You unwind them by sale of some of these things, by refinancing, by operating them and changing the earnings pattern and working these things down, finding alternative financiers. There will be a range of solutions depending on the asset, and it's not just our view. I mean, if you want to refinance something or sell something, you've got to find somebody who wants to take it on or who wants to buy it. So there are processes that we'll go through to work it down.
Have you put anything up for sale, particularly any of the dairy farms or the assets that
No, we haven't. I mean, in the loan book, where there have been non-performing loans, we haven't hesitated to move after security and sell things through the processes of receivership. But in terms of our own assets, we certainly have engaged in negotiations with people that said, you know, is it time for you to take them over? We'd prefer not to finance them, but we haven't put anything on the block with any sense of urgency. And I would prefer not to do so, and really don't intend to, because that's not how you get the best price. The other thing I would say is that many of these assets, and South Island Farms, Dairy Holdings, Scales, and Helicopters are very good assets, and there's no reason to be a distressed seller of them. It would just hurt us, and it would hurt the businesses, and it would hurt the stakeholders as well as shareholders.
Now, South Canterbury has received the extended government guarantee. Mm-hmm. What's happening now to your reinvestment rates for debentures? Because according to the prospectus, they got down towards 60% and lower in mm-hmm. those few weeks before the release of the audited accounts.
Well, reinvestment rates are always bounce around. I have days at 38 and I have days at 65 and everywhere in between. So you've got to look at them over a period of time. Generally speaking, reinvestment rates had been trending downwards for some months. If I looked at the graph and kind of said, well, intellectually, what's going on here? And the major reason for that is that South Canterbury has two constituencies of investors. They've got people that had long relationships with Alan and the company, longer than you and I have been alive.
Right. Yep.
And those are loyalists, and they will invest and maintain a relationship on the deposit side because they have a relationship on the loan side or have had, and there's a real sense of tangible loyalty. There are 40,000 of these people. It is a big constituency, and they're sort of warm-nosed and towards us. And while eventually I think if they had doses of bad news that weren't ending, they would sever those relationships, but they haven't. They've been very loyal, and we appreciate it. That's a distinct segment, and I guess they're conscious of the government guarantee. Then there's a new segment that's come along since the government guarantee who probably had no relationship with us, who say, gee, government guarantee and those sorts of rates, I can't get that anywhere else, I'm in there. So the reinvestment rate is a blend of those two things. We don't publish segmented numbers, but there would be a difference. There's a difference by geography, by age, North Island, South. The reinvestment rates have been going down in broad terms because most investors have in their mind 6 months, a year, sometimes longer. And if they were focused on the government guarantee, either in whole or in part, before the new guarantee came in, it ended in October. A guy would call up and say, I want a rate for 1 year government guaranteed deposit. And you say, no, can do. Well, that's fine. Some of them would take 7 months up until the end of October, and we've got a pile up in there, but we were clearly losing people whose needs we were not able to satisfy. With the extended guarantee, we can say to people, here it is, and it's a rate that is meant to attract those people in. It's an attractive rate in the market.
But doesn't this just extend the problem of this wall of maturities out from early October to the end of next year?
Well, absolutely, in a sense. Now, bear in mind, we're not going to just pile everybody into this again and soldier off into the future. The government guarantee gives us the opportunity to do something quite different. We want to spread that profile out, and we will do that by rate and discussions, road shows next week with brokers, and sort of target people in through market signals and making some maturities more or less attractive. And then we've already started in the prospectus to signal that we need to go into an unguaranteed set of products. I don't want to arrive at the end of this, not the plan to arrive at the end and be where we were this time around. The company needs to be much smarter in terms of diversifying its funding sources wholesale. And we've got some significant funding there, which we're working now on solidifying and re-rolling, reestablishing. And we'll do a range of other things. So if we weren't thinking about it and if we didn't have a strategy, that's where we'd end up. But I'm pretty bound to determine not to end up there.
Because there is the argument, why doesn't South Canterbury Finance just go into wind-up mode, given that the future after the end of the extended guarantee for finance